So welcome to our mid-year outlook 2025, which we have titled Living in a Land of Confusion. Now, just in case you're getting confused, this is our second podcast. Hopefully you've tuned into our first one, where we looked at the global economies and what was happening in terms of growth, interest rates and inflation. Well, this is turning our attention now to the financial markets, where once again, I'm joined by the experts from the MSME team. Now, to kick off, we want to kind of pick up where we left off, thinking about the economies and thinking about interest rates. And I can turn to you, Charlotte, in terms of the global interest rate cycle. We've been seeing inflation be positive, coming down, and we've seen central banks respond to that. So what is your take on this going into the remainder of this year and perhaps a little bit into next year as well?
Yeah, so the starting point is one where inflation is almost back to target. It's not quite back to target. There's a bit of stickiness still in the economies. I think there is a lot of focus on pricing. We have consumers that are extremely sensitive to we saw tariff news in the US. You see inflation expectations being almost unhinged. So I think central banks are very happy. The inflation is kind of back towards that 2 handle in most regions, in large parts of the world. But they're also very cautious because they know that the economy has changed compared to pre-COVID. They know we have a lot of domestic spending in economies where we didn't used to have it. So they are a little bit cautious coming from this inflationary period. So we're continuing to see the same kind of cautiousness, gradual rate cuts in large parts of the world. On a positive note, where we also seen actually a dollar weakening, has opened up for particularly emerging markets to move forward with their rate cutting cycle, and that's particularly in Asia. That's important. These countries didn't have an inflation problem, but you had a very strong dollar, so this opens up for the global rate cutting cycle that was actually disrupted around the US election because the dollar back then strengthened very sharply. That's coming off, so that should be supportive for the global economy over the next half year.
And tell me about the bond markets, because that implies, the front end is coming down. How do you see the shape broadly of curves? I mean, we've seen, the duration side, we've seen the long end struggling most. We see fears about deficits, debt levels. So which way is driving the curves right now?
Yeah, I mean, first of all, bond markets have been extremely volatile. They have been uncertain. No one really knew what was going to happen around inflation, exactly how far central banks had to go in hiking the rates, and that has driven huge volatility in the bond market. The good news is that I would say the most important part, which is the inflation part, that has come down, has largely normalized. We see inflation expectations or market pricing around inflation actually being very benign, and that helps to kind of anchor the global bond yields more broadly. The short end is quite well anchored as well because central banks are cutting rates. There is much less fear now that maybe interest rates have to go even higher. That is kind of out of the picture. There is some kind of conviction that we are back in a more normal rates environment. Not going back to pre-COVID, but also not seeing very high rates like we saw in Brazil, for example. So that means the volatility we're seeing in the bond market is driven by the long end, which central banks is more difficult for them to contain it, obviously. And there are a number of factors there, and I would point particularly to the kind of fiscal concerns and risk premium around that piece. That has already been priced. We already seen a sharp repricing there. So going forward, we do expect yields to come down.
So you think we've seen the highs in long bonds for the year?
Yes, we think we have seen the highs, but we cannot rule out volatility in these markets. Right now, financial markets are not focused on the fiscal deficits, for example, but clearly it hasn't gone away. And I think we need to be prepared the volatility will be high.
And I certainly feel that even with its volatility that's driving this, that were we to break out and were we to see new highs, then it becomes almost self-correcting, because that is going to have quite a material impact, I would have thought, in the global growth dynamic.
Absolutely. I think that's one of the kind of key convictions we have, that there is a level, and here we're really talking about the kind of developed economies, where bond yields kind of become self-correcting because they drive growth in these economies. But the other piece of that thing, and I have to say it, is that the fact the central banks remain focused on inflation, that I would say is very important they keep doing that, because that's exactly the kind of anchor you need in a global economy where everything is changing, and everyone is being confused or where we are moving going forward, the fact that they are still focused on inflation is very important.
And maybe turning to you, Tom, because as Charlotte pointed out, we did see the move higher in terms of bond yields, treasury yields in particular, thinking back to the April time and the Liberation Day tariffs. Was it the bond market that forced the hand of President Trump to say that he had no intention of removing the chair of the Federal Reserve?
Yeah, absolutely. I think we heard a lot about bond market volatility, and I think most of us would agree it's not necessarily a good thing, because everybody likes, or most people like, planability, certainty. But in this case, I do think that this volatility also had kind of beneficial sides, because it is, as you mentioned, I think the high volatility, particularly also the steep rise in treasury yields that we have seen occurring in April, May, have put constraints and quite significant constraints on what the Trump administration is able, maybe less willing, but particularly able to do. And I think you mentioned the example above all, it was about undermining the Fed's independence, because President Trump made it clear many times that he would prefer yields to be much lower. And he even, kind of thought about removing Chair Powell from the Fed. Now, the Supreme Court then eventually also helped us, but it was initially the bond market who made it quite clear that it didn't like the idea. And it took about 48 hours for President Trump to tweet again and come out and say he does not intend to fire Chair Powell.
Now, we can speak a lot about levels for bond markets, but what is clearly a concern for investors, and they want a higher risk premium, is debt and deficits. And we've got our BBB, our big beautiful budget going through, it seems. We spoke a lot about that in terms of the economic side of things, but from a bond market perspective, are we getting to the point where we think it's all in the price? I mean, I was feeling when we got up to these maybe 20, 30 basis points ago that it was well known. It was in every newspaper, every report on TV was speaking about the deficits and the debt levels. And actually I thought, risk-free rate, and I still believe the US is a risk-free asset. You can tell me if you disagree. But to me, that whether it's a sort of a 3.5% real yield, risk-free, that's quite attractive.
No, absolutely, I fully agree. I mean, it's always a bold statement to claim that everything is in the price, because yes, exactly, we have seen that in the past many times, that the investors should have known about something only to realize maybe should have, but it wasn't in the price. But no, in this case here also, I do think that most of the worries of the information is actually in the price. And you mentioned the real yields, which I think is really the figure, the number to look at. And whether it's a 10-year, it's a 30-year, all longer-term real yields are at the highest in decades. Yeah. And that tells me that, yes, I mean, it is attractive. Yes, it does already take into account many of the risks that we do see about fiscal sustainability, about the growth impact, about inflation uncertainty, inflation levels. And I think we have reached a point where were real yields in particular to rise much further from current levels, it definitely would be visible in growth. And that's also what the market is telling us. So yes, I do think, you asked the question, I do think we have seen the highs for this cycle, for this year. And yes, actually treasuries, or more broadly, probably longer term bonds, do look attractive at these levels.
Now, Tom, you have the unenviable position of having to forecast or predict or guess, well, I didn't say that, where bond yields are likely to be at the end of the year. Not an easy task by any means. But, given what you've said, I mean, getting a landing point is virtually impossible. But broadly, you think there's a little bit further downside for, let's use 10-year treasuries as an example. You think they can go a little bit lower than we are today? I
do think so. I mean, we have long been of the view that, interest rates are attractive. And I think that inflation worries have been overstated, particularly longer term with regard to the impact of tariffs. We have seen growth basically being impacted by, tariffs, but global factors as well. And taking all of that into account, I still think, yes, that treasury yields can move a bit lower from current levels. However, we also have to say they already did move quite a bit over the past few days and weeks. But yes, the answer is I think yields can move a bit lower from current levels.
Now, maybe turning to you, Ross, Mr. Duration, I think, as you're now termed in the team here. So you like duration here. You think that's there's a play to be had, which I guess ties in what Tom and Charlotte have said. But you particularly like bunds, and yet in the last podcast you were telling us about how much issuance Germany was going to have. So can you square that circle for us?
Absolutely. So if you listened to the previous podcast, I hope you did, I would recommend you do. We talk about a little bit about Europe, how there is the longer term super positive view, or at least reasons to believe that's going to be the case. But remember, we're in the business of making tactical investment opportunities as well, looking for opportunities that are out there to benefit from. I think in the shorter term, that is the outlook towards the end of this year, we are in a sweet spot for European fixed income and for Bund duration generally. That is because a lot of the reasons that my colleagues alluded to before. I think the growth numbers will be disappointing within Europe because of a lot of the tariff risks. The activity data will be weaker than the market is pricing or anticipating. I also think the inflationary pressure also will tend to come in lower as the year goes on as well. This is to do with energy prices generally. Some of the finally data we're seeing with wage growth being lower, coming off considerably. Service price inflation finally falling, and the euro strengthening, which is this additional unexpected kicker as well. 10% plus. That's going to have a meaningful impact as well. And it could be in the relatively short term. So my view is the ECB will be cutting interest rates once further. And I think even though there is a longer-term view, the bond market does tend to be slightly short-termist in its own pricing as well. So I wouldn't be surprised if we saw lower Bund yields. I also think that if you look at the Bunds versus German bonds versus the comparative bonds across Europe, they actually look quite attractive because they are, yes, still more expensive than Italian, French, and Spanish bonds, for example. But the spread between them is the lowest it has been, in years, even potentially since the sovereign debt crisis, the great financial crisis to begin with. If there is, let's say, a risk-off event, obviously we're not thinking that necessarily in the base case, I can see Bunds doing particularly well in that environment because they do screen cheap versus history. The fiscal stimulus is definitely coming, but I think in the short term the markets can see some real positives.
Well, you're a real believer. Let's hope you're right. But listen, you touched on something very interesting about just the tightness of these peripheral spreads. It seems clearly Europe is getting its act together. Thank you, President Trump. We touched again on that in the previous visit. But tell me, French spreads are now above Spanish spreads. Is that right?
Yes, it is right. I think in this sense, the market gets it. The market understands what's going on in the relative pecking order. So first point overall, spreads in Europe are reflecting a good story in Europe broadly. So, Italy, for example, which still has a very high debt to GDP, its growth hasn't been phenomenal, but there has been some really good incremental progress on getting its finances on an improving trajectory as well. Obviously, inflation, the nominal growth has helped. So the overall environment is positive there overall. As you said, the relative ranking has changed. Spain, which has had very, very strong growth, has been rewarded by the market for doing that. France is in the unfortunate situation where its growth hasn't been phenomenal. It's been better than Germany, yes, but it's not been phenomenal. It also has a rather more unstable financial overall backdrop, and because of the snap election, was called, and the makeup of the National Assembly, a particularly uncertain political outlook right now, which is highly linked to having to basically try and reduce the deficit in this sense. So the risks are high within France that current Prime Minister Bayrou, for example, may face some difficulties when it comes to setting a budget for next year. They need to, the market's going to ask them to lower the deficit further. And there's a lot of pushback on that front. So I think the market is sensibly repricing that. And if anything, I would say, I think this trend can actually continue. I suspect France will still be kind of in the eyes of investors as demanding some risk premium.
Sure. So still clearly preferring Bunds bonds over the rest of Europe. Now, I want to turn to you, Puneet, because I've just heard from my learned colleagues about how great government debt is and thinking about the kind of yields that are on offer here, risk-free rates that are pretty attractive to me. Why would I buy credit? And yet everybody's buying credit. Spreads are getting tighter and tighter.
Well, credit investors, as you know, are not necessarily the most cheerful bunch out there. And I think
Sun is always shining in the credit garden, you tell me. But anyway, carry on.
I think there's a very good reason. I mean, so if you're a credit investor, what is the best which can happen for you? What can happen when things go right? You get your money back, albeit a little bit more than government bonds, but that's it. So credit investors tend to be highly sensitive to downside risk, and typically you don't find that risk premiums are as low as they are today, which is, you know, one of the reasons why we don't necessarily prefer credit. U.S. investment grade credit spreads are almost the tightest they've been in 30 years. U.S. high yield spreads not a bit far from that as well. There are segments within credit which are a little bit more attractive. I mean, municipals is one, asset-backed securities is another one. European credit actually is another one as well, which is more preferable in a way in terms of valuations, in terms of fundamentals. But all in all, I think overall, if you think about credit markets, you don't have a lot of juice there. So there is very low risk premium which is in there. And the reason for that is simply because these valuations are being driven tighter by investors who are yield focused. So the overall yield that you get in a corporate bond today is higher than it has historically been, which is bringing a lot of yield focused investors back into the market, which keeps the spreads quite tight. But
Now, you speak about history quite a lot, and you know, when you look at the chart, spreads are very tight. But aren't the credit markets better today than they were 10, 20 years ago? And shouldn't they therefore be trading at a tighter spread?
Not necessarily. I mean, I think, you know, today 50% of the market is BBB, for example, in the U.S. investment grade.
That's true. Yeah.
So it's not the, and even if we think about spreads as a unit of leverage, which we do tend to look at from time to time, it's actually at the tightest it has been in a very long time. So I think from a number of these perspectives either, I mean, it's not that you're pricing in a good outcome by any means. I think spreads are low and risk premiums are low, which actually makes them quite vulnerable to a downside scenario. I mean, the current spread environment actually reminds me a lot of the pre-financial crisis 2006, 2007 environment where spreads were similarly low as well. Now, what is the difference is we are not expecting spreads to actually balloon out from here. In the absence of a crisis, that will not happen. But were there to be any downside which comes through, for example, if there's a US recession or, for example, the tariff policy actually really backfires on the economic growth, etc., then you will have so much more disproportionate downside on credit as opposed to potential upside, which can be spread tightening of a few basis points, for example, in US investment grade.
So it's not that you're so negative in the kind of the short term, it's just you think there's better opportunities to have, and there's an asymmetry to that risk profile.
There definitely is an asymmetry, and I think, you know, for example, equities, I mean, is a more favorable asset from a risk-reward point of view, which is why I would prefer equities over credit on a hedged basis. I think those kind of opportunities or, you know, those kind of strategies allow you to actually, you know, benefit from the asymmetry in credit during downturns or, you know, rough patches in the market, while during bull market returns, it's not so much of a drag. So within a multi-asset portfolio, it does make sense to reallocate from credit into equity.
So it sounds like, you know, govies give you the yield part, which is quite attractive on a real basis particularly. Mm-hmm. Equities gives you the risk part or the upside part for the risk that you're prepared to take. And kind of credit is you're not going to get much on the upside if things go well, but you are exposed to the downside if, you know, we're wrong and we do have a recession, for example, in the United States. That's how you would see it. Very good. Now, you mentioned equity markets. Let me go back to Tom and the United States, because at the end of last year, everybody was talking about US exceptionalism. Everybody was overweight US equities. They represented, what was it, 70% of the MSCI World Index. Have we seen the end of that? Has that died, US exceptionalism? And is the US equity market ever going to fall back in favor again?
I mean, look, the market or investors, they need narratives, and you mentioned the last two probably. One was that you absolutely have to own, or not even own, overweight the US because the US is exceptionally strong and there's no other place to be. Then came kind of the doom days where the opposite seems to be true, and investors tried to sell US assets. And that was after Liberation Day when everybody thought like, oh no, this is a game changer. But I think the truth is somewhere in between. So the US, in my view, is still exceptional. I mean, look at the business models, look at the depth of the equity market, look at the innovation hubs that exist. And I mean, you have a hard time looking for these, such an equity environment in many regions of the world. So I still think absolutely you have to own US equities, but you also need to be more balanced. There are other regions, and we'll talk about those, that definitely are interesting. And also you mentioned the upside of equity versus credit. But currently, if you look at, for example, the earnings yield, so valuation-wise relative to the bond yield, you get more if you basically simply buy treasuries, longer-term treasuries. But still, I mean, you have to believe in this upside potential that you mentioned in order to pile in on equity. And probably eventually it will pay out, but near-term, you just have to make the balance. You really have to look at that. And I know valuation can remain high, can remain excessive for a long time, but it's a fact if you buy US equities as of today, you are entering the market at relatively high levels.
Now, Ross, the US had been the darling. Europe was the new darling. Is it still a darling, or is it now overvalued?
I think Europe has the potential.
That word again. The P word, the potential for Europe. Great. Yeah.
We talk about US exceptionalism.
Potential
there is
great
potential
again.
for European equity exceptionalism, and honestly, in the long run, I think we are seeing the ground really being laid to that. I mean, and let's be fair, we have seen strong equity market performance in Europe. I mean, not just this year. I mean, also last year as well. So I would put it in this sense. In the shorter term, similar to the views on Bunds, we like Bunds because we are basically saying that we think growth is going to be a little bit disappointing. The near future is a little bit more difficult. I think it's a very similar story that's going to impact the equity market for the remainder of this year, which is, we'll probably have a little bit of a headwind coming against equities because we have had a really big repricing. And when we look at the constituents of that repricing, it has really been in expectations of future profitability, of future earnings, etc. When you actually look at underlying pure earnings growth or true earnings growth in Europe, I mean, it goes quite a good way to explain why the US has tended to outperform in general, which is because US earnings growth has just been a lot higher. For the last 2 years, for example, we've seen very, very limited actual EPS growth at a European level. We need to see that come through. As I said, the potential is being there, the ground is being laid, but I think in the shorter term, the proof will increasingly be on firms to prove that earning growth is actually coming through and not just on the expectation component.
Very good. So let's go to the rest of the world. China. Is there a story to be had? Only about a year ago, people were saying China's uninvestable. We didn't have that view. We thought there was potential there. Is that potential going to be realized?
Well, I mean, after the story about domestic economy is still very weak, a lot of people get disappointed. Is uninvestable or not uninvestable? It depends on the time horizon that you're looking at. Definitely from a long-term perspective, there are a lot of hurdles there. Like you invest money there, can you get it out? How the currency, and what is the growth outlook over the long term, whether China will have a middle income trap and all kind of that story. But from a tactical basis, I find China is a very, very interesting story, especially if you want to play tech and it's still cheap. Definitely not go to the US, you go to China, and especially the shares that are listed in Hong Kong is still very light positioning. We are starting to see steady inflow, especially from mainland China, where the investment options are very limited. People cannot put money in the property market anymore. Bank deposit rate is so low, so that is where the money go to. I think over the second half of the year, Chinese equity, especially the H share, would give quite a compelling story.
Now, we were speaking about darlings there. Japan was a darling of investors last year. Come off the boil a bit this year. What do you think? Is Japan going to struggle for the remainder of this year? And how would you see it relative to China, for example?
Yeah, what I quite like about what Thomas has mentioned is like market need a narrative, right? So a couple of years ago is about Japan have a new dynamism, have a kind of corporate governance improvement. It has been like that for a decade, not just about last year, but definitely the currency plays such a big role in the whole things, because a lot of companies in Japan sitting overseas, a significant source of their revenue coming from overseas. So definitely the currency movement has such a big impact on the corporate profitability. And we see that the central bank in Japan is raising rates since last year, and that kind of monetary policy normalization will continue. Now it's on pause a little bit, but definitely the yen had been strengthening, and that is not good for corporate in Japan. On top of that, they are very exposed to the whole global growth story. And that's why I see that there's a bit of here and there, a bit of rally, but it's going to be capped.
Now I'm going to ask Tom and Charlotte a little bit about the dollar in a minute or two. A weaker dollar generally seen as a good thing for emerging markets. Anything else on that side before we speak to Gustavo, maybe about Latin America that you're seeing, particularly perhaps in the Asian region?
I think it's not been a very easy year for emerging market up until the time where we have a dollar weakness. So it allows central bank to cut rates in some part of the region. And also there are a bit of flows coming into EM when people try to diversify out of the US. But at the end of the day, I think the business model in the US is still very top. In terms from the investor point of view, from the return on equity, even though valuation in EM is relatively attractive. But I think the dollars, I think Thomas will come back to that, but definitely looks relatively quite oversold right now. If we have a reversal of the dollars, and definitely the impact on the EM would be negative. So I would be quite cautious when we think about EM. But I mean, EM is a quite a complex basket, because in EM we have a tech play like Taiwan, we have recently a re-rating from South Korea, that is, we can overweight, for example, but some typical EM that very sensitive to the whole movement of global growth as well as the dollar, and I will be...
But you also like India.
Yeah.
Is that right?
So India is EM definitely, but the story is slightly different there. So one of the countries that are relatively resilient to the whole tariff with the US, because the rest of EM, especially in Asia, are very, very vulnerable to the whole tariff front with the United States. So definitely that is one thing. The second thing is that, India has been a darling in the last couple of years, a bit of a consolidation going through, and now flow is coming back because growth is improving quite a bit in the second half of the year. So definitely valuation is not the most attractive, but I think from the growth story, India also the best market in terms of ROE, in terms of earning growth and things like that in Asia. So definitely also attractive options.
For sure, there's a real story there. But look, Gustavo joining us live on the line from Chile. Thank you for joining us. It's been remarkable performance for some of these LATAM equity markets this year. Massive double-digit returns. Is that all done? Are we done and dusted, or is there still some upside to have in the remaining 6 months of the year?
Yes, as you pointed out, this has been an extraordinary performance year to date. And of course, given that extraordinary rally, it seems that potential upside could have been stretched out. However, we remain constructive. I think that part of the outperformance have been, of course, related with mentioned by Ha in terms of dollar weakness. However, some idiosyncratic things have also appeared. For instance, as we mentioned in the prior podcast, in terms of relative insulation of LATAM, in terms of the US tariff war, and also this kind of more appealing potential shift in terms of more market-friendly administration going forward in several economies within the region. Low valuation from historical levels and potential upside on that could be, well, one of the key reasons that point us to remain constructive on the region.
Very good. So let's round off with the perhaps elephant in the room. Tom, Charlotte, the dollar. Not you, don't worry, Tom, it's the dollar. So the dollar, only at the end of last year, we were being asked about, is this a case of a Mar-a-Lago Accord to bring down the value of the dollar, which we thought was ridiculous. The dollar was in a spike, but even by historic standards, it was kind of still within a broad range. Now, 6 months later, we're being asked, is this the end of the US as a reserve currency? I suspect I know the answer. In fact, I do know the answer to this, but what's your take on all of that?
Yeah, let's pick up the topic about narratives again, and that is obviously quite clearly linked. I mean, you mentioned it. Everybody was kind of talking up the US until quite recently, and now the opposite seems to be true. Everybody talks about the end of US exceptionalism. It's quite interesting. Maybe just a few observations. Yes, it's true that dollar has sold off quite significantly, about 10% if you look at the broader index, but it comes from overvalued levels, quite clearly, according to many measures, starting with the purchase power parity, but there's many more. So it's just a rebalancing. I mean, where we currently are is roughly where we were 5-10 years ago. So kind of an average level, nothing exceptional. We also write in the mid-year outlook about momentum in currency markets. So usually there's a bit of an overshooting, but coming back to the narrative, currently what we have observed, we talked about treasury yields rising quite rapidly. We have seen the dollar weakening. That's a pattern that we usually tend to see from emerging markets, weaker currency and weaker bond markets. So that is unusual. The good thing, the move in interest rates has stabilized. We talked about that initially. We even expect them to fall a bit further, but the dollar outflow has not stopped fully. And it is a quite crowded trade. There seems to be a strong consensus that the trade continues, which is where I usually get a bit suspicious. And I wouldn't be surprised if we do see a bit of a stabilization or probably even a rebound. Once again, what we have seen over the past few months is nothing too unusual. The dollar is not stretched if you look at it in a longer term environment, but the short term move has been quite rapid. So I would expect that narrative maybe to be watered down.
Yeah, I mean, I would certainly agree with you with a crowded trade. It seems to me that the most crowded trade I've heard about so far in the last couple of months. So yes, as you implied, probably a little bit further to go, but broadly a lot of that move is done. Now, one currency, again, the dollar has been weak against. We all speak about the dollar, but the Swiss franc, Charlotte. I mean, the Swiss franc is the safest of safe havens here in our little bubble in Zurich. The Swiss National Bank has cut rates to zero. What's that dollar-franc relationship like now, and where do you think it's going to go?
Yeah, we spoke a lot about darlings here today, and I think the Swiss franc is clearly a darling for many. But there are good reasons for it to be so. The fundamentals are strong. It's a country that is running a persistent and, dare I say, large trade surplus. There is a lot of demand for Swiss franc. It's also a country that has persistently undershooting other regions in terms of inflation, and over the past few years that has become very important. And it's also a country where, as you say, interest rates have already fallen to zero. So there is kind of there is not a lack of policy space, because you create policy space. If you need policy space, you create it. But all of that together means that, yes, the Swiss franc is probably likely to remain strong. It has fallen or risen to a historical high.
Could we get interventions to weaken it, just from a domestic Swiss economy perspective?
Yeah, I mean, clearly the strength versus the dollar, maybe slightly less so versus the euro, is a headwind for the domestic economy. The manufacturing sector is very important in Switzerland, especially kind of smaller and mid-sized companies. They are struggling, and on top of it, of course, they have tariffs. So clearly, controlling and avoiding a further sharp increase in the Swiss franc is a key policy objective. And I think the Swiss National Bank was very clear about in the last meeting, where they cut rates to zero, that FX interventions remain part of their kind of policy toolbox. Compared to what we've seen previously, I would suspect they're going to be much less kind of aggressive on that side going forward. And I think when we think about the Swiss franc, as we said, it has already strengthened, actually has strengthened ahead of most other countries versus the dollar. And we think that we are not going to see much more strength on that side. But risk to the Swiss franc is always to the upside.
Great, thank you for that. Thank you to all of you for listening, to the MSME team generally. So to round up from a market perspective, I mean, it seems that we believe that some of the bond moves that we had early in the year were overdone, seeing some highs reached, we think, back in April time. Bond yields, we think, can moderate a little bit, certainly over the remainder of this year. As you heard from Punit, the risk the risk premia being offered in the credit markets, we don't really think is is reflective of the risks that are there. And certainly if we want to play upside, which we do, we see more of that upside coming in the broader equity markets that perhaps are not quite as capped as some of the credit markets are in terms of hitting the lower bound for spreads. It is worth saying that although fundamentals are still challenged, you heard that in terms of our economic podcast, that means that revenues on margins are going to find it difficult for the remainder of the year. It is worth pointing out in that last point about the US dollar, that dollar weakness, the 10% decline that we have seen, should be helpful certainly for US corporate earnings. So maybe this brings investors at least to turn their attention back somewhat to the US markets. But I think one of the key drivers right now as equity markets break out has been a function simply of momentum. A lot of institutional investors have been short the market. They've been struggling to close the shorts and in some cases going long to play performance into year end. We continue to see retail investors buy the markets and buy any dips that they can. And certainly within the US market, we're seeing corporations that have got very, very strong cash flows, cash balances. They're continuing to be doing their stock repurchases. So there's a number of reasons beyond fundamentals, which maybe are a little bit stretched, why this market continue to grind higher. But as we always say in this world that we're living in, a land of confusion, there's likely to be still a great deal of volatility over the period going into year end, so one has to be nimble. Once again, thank you all for joining us. If you haven't already, please do listen to the podcast that we've just put out on the global macroeconomy. And remember, as always, you can read our full report, see our videos, and we can pick that up on zurich.com/MSME. And we look forward to again speaking to you very soon.